Greetings from MWN.com. Dr. M. Wilson, formerly Vice Principal and Head of Department of Commerce, Scott Christian College, Nagercoil, is delighted in presenting this session. Thank you. Please subscribe the channel MWN.com. Accounting Principles. Accounting is the basis of measuring the performance of the companies. The methods adopted in measuring the performance should be common to all companies so that all the interested parties can easily understand the method. Hence, common accounting principles are adopted throughout the world to write the accounts. This common accounting principles is referred to as Generally Accepted Accounting Principles GAAP. Classification of accounting principles. 1. Accounting concepts and 2. Accounting conventions. Accounting concepts. 1. Accounting period concept. 2. Dual aspect concept. 3. Business entity concept. 4. Going concern concept. 5. Money measurement concept. 6. Cost concept. 7. Matching concept. 8. Realization concept. 9. Objective evidence concept. 1. Accounting period concept. Proprietors of business want to know the profit or the return on their investment. Most of them want to get the profit within a very short period. The period may either be 3 months, 6 months, 1 year, or even 2 years. It depends upon the nature of the business and the desire of the proprietor. But the real profit of the business can be known only when the business is closed. Difference between the net assets in the end and at the beginning will give the real profit from the business. But the businessmen will not wait till that period. Moreover, the business will exist for a longer period. Hence, the reasonable accounting period accepted universally is 1 year. The accounting year is either from the 1st of January to the 31st of December, or from the 1st of April of a year to the 31st of March of the next year. The Companies Act and Banking Regulation Act are insisting on preparing the accounts for a period of 12 months every year. Income tax authorities also insist on preparing accounts for taxation purpose for 12 months every year. 2. Dual aspect concept. The basic accounting concept is the recording of every transaction into accounts. Every transaction has 2 aspects. One is the receiving aspect and another is payment aspect. The receiving aspect is called a debit and the payment aspect is called credit. For example, a transaction like purchase of machinery for 12 lakh rupees has receiving aspect as machinery received and payment aspect as paying cash 12 lakh rupees. Hence, the machinery account is debited and cash account is credited. The accounting equation, that is, assets equals equities, is based in the dual aspect concept. According to the dual aspect concept, the total debits will be equal to the total credits in an accounting period. 3. Business entity concept. This concept states that business is separated and distinct from the proprietor. The accounting for the business includes only transactions of the business and not of the proprietor. If the proprietor has any transactions with the business, that would be recorded in the books of accounts of the business. For example, payment of capital to the business, withdrawal of money from the business, purchase of goods from the business, etc., are recorded. But the personal transaction of the proprietor would not be recorded in the accounts of the business. Only, transactions of the proprietor with the business should be recorded in the books of the business. The accounting equation clearly explains the meaning of this concept. The accounting equation, that is, assets equals liabilities plus capital, includes the amount the business owed to the proprietor. The assets indicate the total assets of the business, liabilities indicate the amount the business owed to outsiders, and capital indicates the amount the business owed to the proprietor. 4. Going concern concept. According to this concept, the business has a long life. It will continue to exist for an unlimited period, unless it is dissolved due to unavoidable circumstances. The business may be dissolved due to insolvency or death of a partner, or due to accumulated losses for a long period of time. The final accounts are prepared on the basis of the going concern concept. The fixed assets in balance sheet are recorded on the basis of cost after deducting the depreciation. Recording of advance payment of expenses, outstanding expenses, accrued income, and income received in advance are examples to show that the business will continue to exist for a long period. 5. Money measurement concept. The transactions which can be expressed only in terms of money can be recorded in the accounts of the business. Non-monetary events could not be recorded in the accounts. For example, 1. The conversations between the manager and supervisor, health conditions and satisfaction of the employees, etc., could not be recorded in account books. 2. Weight of machines, area of building, location of land, etc., also could not be recorded since these events cannot be represented in monetary terms. The limitation of the money measurement concept is that actual money spent for acquiring assets only can be recorded ignoring the value of money. The assets purchased in ancient days is treated the same way as that of assets purchased at present. The money value of the past period is not taken into consideration for writing the accounts. 6. Cost concept. This concept implies that the fixed assets should be recorded at the cost at which they are acquired. Depreciation is deducted every year on the cost price while recording it in the balance sheet. This value is called book value. The market price may be different from book value. Market price fluctuates often. Hence, it may not be taken as a fair measurement. In order to overcome the differences between market price and book value of assets, a new system of accounting called inflation accounting has been adopted in certain situations. This accounting also has its own limitations. When the asset is recorded on the basis of inflation accounting system, the assets do not match with the liabilities. Moreover, the system has no legal acceptance. Hence, the historical costing based in the cost concept is universally recognized and adopted. 7. Matching concept. The main objective of a business is to earn maximum profit. The proprietor wants to know the profit year by year. To ascertain the profit for a period, the revenue earned should be matched with the expenses incurred. The difference between the revenue and expenses is treated as profit. While calculating the revenue, expenses meant for that accounting period should be taken into account. Sometimes, the revenue received in advance or revenue outstanding may be existing. This should be adjusted to calculate revenue meant for the accounting period. Like that, the outstanding expenses and expenses paid in advance should be adjusted to calculate the expenses meant for the accounting period. The effect of the net revenue is known through the increase or decrease in the capital. Net profit will increase the capital and net loss will reduce the capital. 8. Realization concept. This concept states that revenue is treated as realized on the date at which the buyer takes delivery of the goods. The date of placing order, the date of producing goods on the basis of order, and the date of making payment for the goods should not be taken into consideration for accounting purposes. The date of realization of revenue for rendering service may be either on the basis of completed contract or on percentage of completion method. In installment system of selling, revenue realized is the date of down payment and date of installments. It is treated as gradual realization of revenue. 9. Objective evidence concept. According to this concept, every transaction recorded should be an authentic one. It should be supported by documentary evidence. Documentary evidence may be in the form of vouchers, bills, invoices, cash receipts, etc. This will prevent errors and fraud in the business. Accounting conventions. 1. Convention of disclosure. 2. Convention of materiality. 3. Convention of consistency. 4. Convention of conservatism. 1. Convention of disclosure. According to this convention, all accounting statements should disclose all material information. This is required for the benefit of all the internal and external users of final accounts. Schedule 6 of the Companies Act 1956 states the form in which the balance sheet and profit and loss account should be prepared. All material facts are automatically disclosed by preparing the final accounts in the prescribed form. 2. Convention of materiality. Accounting contains all the material and immaterial facts. All material facts should be disclosed in the final accounts. Immaterial facts like minor expenses, example, minor repair to fixed assets, can be mixed with material facts, fixed assets. It need not be shown like material facts in final accounts. It may sometimes be ignored and need not be mixed with material facts. 3. Convention of consistency. Consistency means continuous practice of the same principles and methods of accounting every year. If there is no consistency, then it is not possible to compare the final accounts of one year with those of another year. Hence, consistency is an important factor for making comparison and taking managerial decisions. Providing depreciation for fixed assets either on fixed installment method or diminishing balance methods is an example for maintaining consistency in accounting records. Same methods should be adopted every year for charging depreciation to fixed assets. If different methods are adopted year after year, then it cannot be stated that there exists consistency in the accounting. Consistency does not insist that new changes in accounting system should not be followed. Any new innovation in the accounting system should be accommodated in writing the accounts. Hence, consistency is maintained without affecting the efficiency of the accounting system. 4. Convention of conservatism. It is difficult to estimate the future. Future is uncertain and the business may either give profit or face loss in future. Businessman may expect very good profit in future. But there are chances of incurring losses in future also. Hence, there is a need to make provision of some money to meet the losses in future. This is called the conventions of conservation. The provision of money for future should be optimum. Too much provision may affect the present profit, and providing small amount of money for future may not be adequate. It depends upon the nature and size of the business. Conservatism is followed in the methods of writing accounts also. For example, closing stock is valued at cost price or market price, whichever is lower, in order to protect the possible losses in future. Accounting cycle. Accounting cycle refers to the continuous sequence of repeating the accounting procedures every year. The accounting cycle includes the following. 1. Recording the transactions from journal or subsidiary books. 2. Posting the journal into ledger accounts. 3. Closing the accounts and preparation of final accounts. The above-mentioned cycle is meant for one accounting year. When one cycle is completed, it should be repeated next year.